Good morning, everybody. Welcome to February 2022 monthly market update with the Aaron Powell team and our family's agent. Today, we're going to be talking about three things. We're going to be talking about how ownership is a hedge against inflation. We're also going to give you an update on the mortgage rates. And then we'll also talk about the forbearance program that was implemented back in 2020 and see how that's affected the housing market. Then at the end, we're going to talk about three different counties here in eastern Pennsylvania and how we've been doing where we are right now. That's going to be Bucks, Montgomery, and Lehigh counties. So homeownership as a hedge of inflation. We'll start with a quote by Mark Hewson, who's a financial writer with Investopedia. So real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So what he's saying there's a correlation between inflation and home values. So what we're going to see next on this next graph is how closely they are aligned. So in the blue bars, well, we went back 50 years and we did it by decades, the 70s, 80s, 90s, and beyond. The blue bar is going to show the inflation rate during that 10 years versus the green bar is going to show the home price appreciation during the same 10 years. So as you can see, in the 1970s, home values increased beyond faster than what the rate of inflation was. 1980s, there was a bit of high inflation, especially at the beginning. If you guys remember, 18% interest rates on mortgages and that sort of thing. So there's definitely a lot of high inflation at the early part of the year of that decade. In the 1990s, home price appreciation started to increase beyond inflation as well. It was a little bit tamer inflation rates. And then we had pretty modest growth on homes. In the 2000s, about the first 2/3 of it, the home values were actually increasing a whole bunch, a lot more than the 2.3% that it was, ended up at. But if you remember, in the 2007, 2008, and 2009, that's when the market fell. So home values decreased in price during that time period. So that's one of the main reasons why the home values did not increase beyond inflation during that 10 years. But what hurt the 2000s actually helped fuel the next 20 plus years in home price appreciation growth. So in the 2010s and teens, inflation was again pretty modest, 1.8%. Values of homes started to increase. In the early part of the year, of the decade, still there was a lot of homes in inventory. People just weren't buying at that time. But then during the second half, there was a whole bunch more inventory that came off the market, which helped push prices up further. Now, if you look at just the last 2 years, 2020, 2021, just look at the massive growth that we've seen in home values. Now, this is across the nation here in eastern PA. In some neighborhoods, some counties, we've actually seen the value of homes go up more than what's shown there. But back in the 2020, that's when the pandemic came in. Inflation was still really low, but believe it or not, because of the lack of inventory, that pushed prices up high. And then 2021, it was just a repeat of 2020, but it was actually a little bit worse because we had less inventory during that year. And then this year, we don't have any data on it now, but I can tell you from what I've been seeing out there, inventory is even lower. And it's even more competitive than it was last year. So when we start talking about the values of home increasing, well, what about the values of rents or the cost of rents that people are starting to incur now? Well, I can tell you because we've been managing rentals since 1999. I have never seen this rate of growth in rental prices that I have within the last 2 years. So when people are thinking about, well, should I buy now? Should I buy later? Just remember that the price of rents do increase over time. The price of homes increase over time as well. So take that, hopefully the incomes also increase as well. But just remember that those two things are going to be increasing year over year, almost every year. Now here's a quote. A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, your property taxes may go up, as well as your other expenses, living expenses, home insurance, that sort of thing. They may creep up, but your monthly housing payment will remain the same. And that's certainly not the case when it comes to renting. So let's see how rents have compared with the rise of inflation over the years. So in the blue line, we've got the core inflation rate from 1973 through 2020. And then the green line is going to be the rental price appreciation, of how much, what percentage rental rates have increased during that same time period. So as you can see, almost every year, the price of rents has outpaced inflation. So from an investment standpoint, that's great. Buy a rental, you'll be able to increase rents. The money that you get back from there should be outpacing the inflation rate, that sort of thing. But if you're currently renting, just keep this in mind if you're on the fence about buying, is that over time the rents are going to continue to go up. Now here's a quote from Natalie Campisi, the advisor staff for Forbes. She said that homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. So what she's doing is she's essentially saying, hedge your future cost of living, your housing cost. Hedge it today, buying something today and locking it in for the next 15 to 30 years. By not doing so, the cost of homes is going to be a little bit higher, as well as the cost of lending is going to be a little bit higher as we get into the mortgage side. So here's another graph. This graph is actually a compilation of data from about 100 economists and data analysts, all in the real estate market. What they did, they split them in half. They said half of them are optimists, and this is what the average cumulative house appreciation for the next 5 years is going to be. They did this back in Q4 of last year. And then they took the other half and they said, okay, these are considered the pessimists. They're saying 23.7%. Now let me put this in perspective for you. So the most pessimistic economists and analysts out there are saying that at a minimum, houses are going to increase in value by 23.7%. And then an average, maybe 40%. So let's put this in dollars terms, right? So a $400,000 house, if it goes up by 20%, it's now $480,000. If it's $500,000 home, now it just went up another $100,000 to $600,000. If you're in the $1 million plus range, just remember, $1 million priced house today is going to be 1.2 here in about 5 years or so at least. But what happens if it is 40%, or 50%, over the next 5 years? Which over the last 2 years, you might be able to see that might be possible, but who knows? But just use this to understand that the values of homes are expected to go up. Now, real quick about this slide here. So I'm a part of a moderating group for a financial mastery class. One of the videos that actually we put on here for everybody to look at is called How the Economic Machine Works. It's really, really informative. So if you have any questions about the economy, how everything kind of works out, if you're worried about the debts, if you're worried about inflations, all those things, if you're worried about economic cycles, check it out. It's very, very informative, and he did a really good job on it. He also has another series on there called Principles for Success. If you get a chance, check those out. Then if you Google his name and inflation, he'll give you his thoughts on inflation as well. I like Ray Dalio, mainly because his stuff that he puts out is data-driven. Mortgage rates, that's our second topic. So this article is from Sam Cater, Chief Economist for Freddie Mac, that was produced back in February 3rd of 2022. So back earlier this month, he said mortgage rates remain unchanged from last week. He said the economy lost some momentum in January, leaving mortgage rates unchanged from last week and relatively flat for the third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues, going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that homebuyer demand continues to be elevated as supply remains low, driving higher home prices. So at this time, as of February 3rd, the 30-year rate was 3.55%. Earlier this week on Monday, rates were 3.69%. Yesterday, which was February the 18th, the rates were 3.86%. So as you can see, in less than a month, we're really starting to climb up in there. So here is a chart of the 30-year fixed rate going back to January 2020 to today. So we were up to we're right now about where we were back then. Then in 2020, we had the pandemic, rates came down low, there was massive refinancing, there's home buying helping to spur the economy. So remember that 3.55%. So now if we go back here, here's another chart that goes back to January of 2018. So from a 3.55 or even 3.86% right now, we're still below where we have been during the last 4 years. But here's a quote from, again, Sam Cater of Freddie Mac. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level homes for sale should keep the housing market competitive. This is very, very true in our market. There's a lot of first-time home buyers out there that are just getting priced out. They're good, well-qualified, buyers. Unfortunately, there's a lot of people coming in, whether they're investors or other people that are paying well in excess of the list price, waiving inspections, appraisals. A lot of them. There's actually been an increase in the number of cash offers that have been coming out in the market over the last couple of weeks. So hopefully that'll start to temper again like it did last year as we get a little bit further into the spring. But right now it's just a really competitive market in the first-time home buyer range. Then Sam continued to go on and said, in 2022, we expect purchase originations to grow from 1.29 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 in 21 to 1.2 in 2022. Essentially, what he's talking about here is, as you saw in the previous chart, right? So rates went down. So during the 2020, 2021, everybody that could they refinance at these historical record low mortgage rates. And so we had massive refinancing during the last couple of years. As rates are ticking up, there's going to be a lot less people refinancing because, again, rates are going to be higher than what they were. There's going to be no reason for them to refinance. So the bulk of the mortgage activity going forward is going to be on the purchase side. One of the reasons why I wanted to point this out is because you may see some things in the news that comes across, mortgage applications are down, mortgage originations are down, that sort of thing. More than likely it's going to be due to the lack of refinancing. So if you hear that, just try to pick out or decipher if they're talking about overall or if they're talking about purchases. Because if you start seeing the number of mortgages on the purchase side starting to decline, that's something to be aware of as well. That could either be a lack of inventory, and so people just can't get a mortgage because there's no home to buy, or the demand is lessening, and you start seeing the demand lessen, you start seeing an increase rise in supply. That's when you'll start seeing a more tempering of the market. All right, so mortgage rates compared to the last 5 decades. I've seen charts like this, and I'm sure you have as well, for the past 20 years. Historically, mortgage rates are really low compared to where they were back in the 70s, 80s, and then 90s. And there is some truth to that. Today's rates are still, 4%, still crazy low compared to everything historically. But whenever it comes to people that are looking to buy or refinance today, it's hard to take a long-term perspective on that. And so they always compare it to what's the lowest rate that they've seen ever, which is just probably last year or so. Just if you're in the market to buy or refinance, don't worry too much about the rising interest rate at this time. The way that it kind of breaks down is about every 1% of increase in mortgage rate is going to cost you about $55 to $56 in mortgage payment each month. So if you have to buy, if your mortgage is $100,000, well, and it's 1% higher, it's going to be $55, $56 more. Of course, if it's $200,000 more mortgage, it's going to be double that amount, that sort of thing. All right. 10-year Treasury skyrocketing, 10-year Treasury rate. So the reason why I put this in here is as you hear a lot about the Fed fund or the Fed Reserve raising interest rates, right? A lot of people think that they control the mortgage rates, and they don't. Uh, they influence them, and they try to influence them that way by spurring people to borrow and buy and spend because the borrowing rate is lower. But the 10-year Treasury and the 30-year mortgage rates, as you'll see in this next chart, are pretty identical for the past 50-some years. So far this year, the 10-year Treasury went from 1.43% to 1.81%. I believe within the next couple of weeks or so, it's going to get close to 2% or over, which means that the mortgage rates, we're going to see 4% interest rates here anytime. Now, are we going to stop at 4%? I don't know. It may slow down, but at this time, everything that I've read and heard is that 4% interest rates are right around the corner. Now, the second chart over to the right, you probably can't see it too well, but that's just a longer term view. It goes back to, I believe, 2017, all the way up till Thursday, I believe. It's a 5-year chart. Just kind of gives you an idea of what the 10-year Treasury rate is. If you watch that Ray Dalio, how the economy works, he goes into a lot better and more detail than what I just did. All right, so here's a chart with the relationship between mortgage rates and 10-year Treasury over the last 50 years. So the Treasury yield is in the blue line. The 30-year fixed mortgage rate is in the green line. As you can see, it's almost identical for the past 50 years. So if you want to have intelligent conversation with somebody about mortgage rates, you don't really want to bring in the Fed funds rate. You want to bring in the 10-year Treasury rate and keep an eye on that. Forbearance program. We're going to talk real briefly about the Mortgage Forbearance Program that came out in 2020. Congress passed it to help keep people in their homes. Let's see how that looks. So back in May 2020 is when they came out with it. There was 4.76 million people in the Mortgage Forbearance Program. As you can see over the years, things have, there we go. As you can see over the years, things have slowly started to decrease, which is a great sign, right? So we're down to less than 1,780,000 people are still in the Mortgage Forbearance Program. And so if you look back at that, that's over 4 million people that started off at that time that is now out of that program. This is huge when it comes to, when you compare this, what we've gone through the last couple of years compared to what we went through back in 2008 and 2009 time period. Just wasn't there. That's one of the reasons why there was such a huge increase in number of foreclosures. So let's take a look and see all these people that were in the forbearance program, how did they exit and where are they currently at? So in the green side, it's going to be 38.1% either got caught up, made their payments, sold the house, refinanced it, or somehow or another brought everything up to good. The next biggest side is going to be 43.7%, which they ended up working out the repayment plans. Now this portion here is really what we didn't have last time in 2008. So in the blue portion, 14.6% either remodified with the lenders or they did a loan deferral. So the lenders really stepped up this time to help keep things afloat and not go through the same housing crash that we saw last time. Now the 18.2% are people still in trouble. So here's another difference that we have nowadays that we did not have back in 2008, 2009, and so forth. So most of the people that have owned a home over the past 3-5 years, right, they have equity in their home. That was vastly different than what happened in 2008 through 2010 period, right? So people that wanted to try to sell their house had to go through short sales or go through the foreclosure process back then. Nowadays, people that are in trouble, heck, it's a good idea for them to sell their house and try to recoup. They have costs to selling, but in most of the cases, they'll still be able to walk away with money in their pocket if they sell in today's market. And that's just because they have equity because of the values of homes have increased. So again, much different market today than what we were 12 years ago. So let's talk about foreclosures. let's go back last 4 years to see where today's foreclosure rate is compared to what it was before then. Now, on another chart that we'll see coming up, you're going to see how many homes started the foreclosure process. This one actually is how many homes were actually foreclosed upon and people lost their homes. So 2017, 18, 19, the average number of homes lost to foreclosure was about 290,000. 2020, pandemic hit, Mortgage Forbearance Program came out. Thank you, Congress. That actually helped keep a lot of people in their home. So the number of people that actually lost their homes during 2020 was only 129,000, which is sad, but it could have been a whole lot worse. So now let's see what happened last year, 2021. Even a lower number of houses was lost to foreclosure, which is fantastic. Only 29,000 lost their homes last year. Who knows what the next few years are going to look like, but as far as what I've been hearing, of course, there's going to be an uptick in the number of foreclosures this year and the following years because people are exiting that forbearance program, but it's not going to be anywhere near what we were previously. So on this graph here, as you see, it shows you that the rate or the number of homes that had foreclosure filings started against them. So of course there was a big tick over a million homes started the foreclosure process from 2017 or 2007 through 15. Those are in the red. Everything in the blue is less than a million. So prior to the run up, there was a lot less. We had the spike. Now we're getting down to lower levels. Still 151,000 people last year had the foreclosure process started against them, which is a lot, but it's not anywhere close to what we've been or where what we've seen previously. So McClare Bolton Smith, Senior Leader of Research at CoreLogic, says that we may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick, though, from an extraordinarily low level. We're not expecting to see a big increase. We do expect delinquency rates overall on home mortgages to actually continue to remain quite low. So here we are at our local market update. We will first start with Bucks County, PA. Now what this chart does, it shows the activity from Q4 of 2020 up to Q4 2021. The median sales price went up by 8.9%. The average sales price went up by 5.3%, which on a side note, the data may be correct, but it just seems like the home values have gone up a whole bunch more than just that 5%. The thing that I want to focus on is going to be the number of homes for sale. It decreased by 52.2%. So just last quarter, Q4, there was only 453 homes that came up for sale, which is crazy low. So if you're a buyer out there and you're thinking, man, there's just not any homes for sale, you're absolutely right. There just are not a lot of homes for sale, which of course, when there is lack of supply and there's a lot of demand, what happens? Of course, prices they have to go up. Now on the market activity, that kind of gives you an idea of the number of homes for sale, number of closed sales during Q4 19, 20, and 21. Here's a graph of historical median sales price for Bucks County. As you can see, we're usually pretty stable. We go up a little bit at a time and pull back, throughout the end of the year, and then we go up again in the spring, which is pretty standard, pretty healthy for most real estate markets. But as you can see, there's been a much greater increase in the median sales price over the last couple of years. Here's Montgomery County, Pennsylvania. Same slide, same data. Median sales price went up 6.5%. Average sales price went up 6.4%. Again, the number of homes for sale decreased down by 61.7%. So Q4 of last year, only 623 homes for sale, which again is crazy low. Market activity, Q4 19, Q4 20, Q4 2021. This is the historical mean sales price in Montgomery County. Again, it's almost identical to what we saw in Bucks County as well. Lehigh Valley, people up north where it's a little bit colder. We've got a different chart for here. This is for January, just last month. The average number of days a home was on the market is 22. Previously, the average for a pretty healthy market was about 50 days, 50 to 60 days or so. So we're well below that average. Number of new listings last month, 532. So there's been an uptick in the number of homes for sale up there. So if you're looking for a little bit more value of a home, a little bit more land, a little bit bigger, there's a better chance of you getting a little bit more home and land for your money the further north you go and the further west you go into Berks County. So the average sale price of homes January 2021 versus 2022 went up 16%. So 232 versus 270. Now we've come to the end of our February 2022 market update. Just a couple of additional notes is we're in the process of redesigning our website. Once that happens, we'll send out a post so you guys can check it out. Right around the same time, we're going to have an updated spring buyer and seller guides available too, anticipated to come out around March the 4th or 5th. So you want to check those out. If you have any questions at all, feel free to reach out to me or my team. We're always here to help and answer questions, even if you're not quite ready to buy or sell. If you're worried about, hey, if I sell, can I find a house? Give me a call. We can have an honest conversation about it. Last couple of slides are just going to be where the resources, where we got everything from. So I'll throw this up here. You feel free to check them out at any time. But thank you for your time. I hope you have a good month.